Imagine you're a bank and you suddenly need some extra cash. Where do you go? You can't just print more money, right? You need a reliable source to borrow from. The Reserve Bank of India acts like a bank for banks. It's the institution that other banks turn to when they need funds. Banks can borrow money from the RBI for a short period, usually overnight. This helps them manage their day-to-day operations smoothly. The interest rate at which the RBI lends this money is called the repo rate. It's a critical rate that influences the entire banking system. It's like the interest rate your bank charges you for a loan, but this time it's for banks borrowing from the RBI. This rate is pivotal for the financial health of banks. The repo rate is a crucial tool in the RBI's monetary policy toolkit. By adjusting this rate, the RBI can influence the economy. It's one of the ways the RBI controls the flow of money in the Indian economy. This control helps in maintaining economic stability. When the RBI changes the repo rate, it directly influences the interest rates that banks charge their customers for loans. This can affect everything from home loans to business loans. This in turn impacts borrowing, spending, and overall economic activity in the country. A higher repo rate can slow down borrowing, while a lower rate can encourage it. The Reserve Bank of India, often referred to as the RBI, serves as the central bank of the country. It plays a critical role in ensuring the stability and growth of the Indian economy, acting as a financial lifeline in times of need. One of its primary functions is to manage liquidity in the banking system, which is essential for the smooth functioning of financial institutions. This involves ensuring that banks have enough cash available to meet the demands of their customers, whether it's for daily transactions or unexpected withdrawals. When banks face a shortage of funds, they can turn to the RBI for short-term loans, which helps them maintain their operations without disruption. These loans are typically provided through a mechanism called the repo market. In this market, banks pledge government securities as collateral to secure the necessary funds. The interest rate charged on these loans is known as the repo rate. This rate is a crucial tool in the RBI's monetary policy arsenal. By adjusting the repo rate, the RBI can influence the amount of money banks borrow. This, in turn, affects the amount of money available for lending to businesses and individuals, impacting the overall economic activity in the country. When the RBI raises the repo rate, it becomes more expensive for banks to borrow money. To maintain their profit margins, banks typically pass on this increased cost to their customers by raising the interest rates on loans. A higher repo rate translates to higher EMIs for home loans, car loans, and personal loans. This can discourage borrowing and reduce consumer spending. While a repo rate hike might seem unfavorable, it is often necessary to control inflation. When inflation is high, the prices of goods and services rise rapidly, eroding the purchasing power of consumers. By increasing the cost of borrowing, the RBI aims to curb spending, thereby reducing demand and bringing inflation under control. Section 4. Repo rate cut. A boost for the economy. Conversely, when the RBI reduces the repo rate, borrowing becomes cheaper for banks. This often leads to banks lowering their lending rates, making it more attractive for individuals and businesses to take out loans. Lower interest rates can encourage investment, boost consumption, and stimulate economic growth. When the economy is sluggish, a repo rate cut can act as a catalyst for growth. It can encourage businesses to invest in expansion, create jobs, and boost overall economic activity. However, a sustained period of low interest rates can also lead to excessive borrowing and fuel inflation in the long run. Section 5. Repo rate. A balancing act for sustainable growth. The repo rate is a powerful tool that the RBI uses to maintain a balance between controlling inflation and fostering economic growth. It is essentially the rate at which the Reserve Bank of India lends money to commercial banks, and it has far-reaching implications for the economy. Increasing the repo rate can help tame inflation as it makes borrowing more expensive, thereby reducing the money supply in the economy. However, it might also slow down economic activity as businesses may find it costlier to finance their operations and expansions. On the other hand, decreasing the repo rate can stimulate growth by making loans cheaper, encouraging spending and investment, but it carries the risk of igniting inflation as more money in the economy can lead to higher demand and subsequently higher prices. The RBI carefully monitors various economic indicators such as inflation, GDP growth, and global economic conditions to make informed decisions. These indicators help determine the appropriate level for the repo rate, ensuring that the economy remains on a stable path. The goal is to find a sweet spot that ensures price stability while promoting sustainable economic growth. This delicate balance is crucial for long-term prosperity. The repo rate, therefore, plays a pivotal role in shaping the economic landscape of India, influencing everything from consumer spending to business investments.